mode.
Good afternoon, everyone, and thank you for joining on this webinar, which is hosted by HDFC Securities. And today I'm here to talk about a new fund which Mirae Asset is coming out with. My name is Siddharth Srivastava, and I head ETF products at Mirae Asset Mutual Fund. Now we are coming out with another interesting offering, and this offering will provide investor the access to manufacturing segment in India. In fact, we are coming out with two funds tracking the same underlying index. One is an ETF, and the second one is the fund of fund. The ETF will directly be investing in the stocks which are forming part of Nifty India Manufacturing Index, and whereas the fund of fund will be investing in the ETF only. So it is up to the investor which route they prefer. If they prefer to buy and sell ETF based on intraday net asset value on the exchange, just like stocks through their broking account, then they can choose the ETF. But if people prefer to use a normal mutual fund route, buy and sell based on the day and NAV of the mutual fund, do facilities like SIP, STP, etc. with the AMC, then fund of fund is probably a better route for you. Please note that typically fund of fund will come at a higher TER, whereas the ETF will be at a lower TER. So just to give you a breakup, ETF will cost around, let's say, 37 to 40 basis point pre-GST, whereas the fund of fund direct plan will be around 60 basis point pre-GST, and the regular plan will be around 1.05% pre-GST on the higher side. So these expense ratios might change somewhat, but this is a ballpark figure. Typically, how the expense ratios of ETF versus the fund of fund are different, but they provide different type of mediums for investors to take exposure in this very interesting index which Nsc has recently come out with. The NFO for both the fund has already opened. It opened yesterday on 10th of Jan. For ETF, it closes on 20th of Jan, whereas for the fund of fund, it closes on 24th of Jan. Now, why manufacturing? So reasons are multiple, right? India, we all know, is primarily a service-oriented economy, right? One of the core holdings, core companies, if we look on stock exchange on a daily basis or in general, are banking and financial sector companies, are companies belonging to IT consultancy, etc. And that is how typically their share in India's GDP has grown over time, and that is where India's competency in terms, especially on the IT consultancy, lies, right? But what we have been trying to do in last 10-15 years is actually to focus more on the manufacturing side, right? Because if India has to become a middle income economy, if India has to create jobs for a huge young population, if India has to reduce the import, increase the export, uh, improve the trade imbalance, and make India increasingly integrated with the global value chain, then manufacturing is the way to go. And that is why the government, especially right now, is focusing a lot on this sector, right? We are hearing about it on a regular basis. And and this is not something which is a recent phenomena. Even 5 years preceding the pandemic, India's manufacturing segment was in fact doing well. In fact, our share in global exports actually increased. In fact, the manufacturing segment of India performed better from a growth point of view than the China's manufacturing segment. So the momentum was there before the pandemic for 5 years, but obviously it slowed down because of the pandemic. And in those 5 years, the the contribution of manufacturing sector increased to almost 17% in GDP. So decade back it was around 12%. Decades back it was around 12%. Slowly, we have been able to reach it to 17%, which is still low. If we look at the contribution on a global level, we only contribute around 3% or so in the manufactured goods, which is pretty low, right? And the endeavor in last decade has been to increase this, and endeavor right now of the government is to increase it, and because of which they have come out with very unique ideas, right? It started with Make in India initiative, which recent government came out with. Now the entire push is along the Atmanirbhar Bharat, and also one very interesting scheme, which is production linked incentive scheme, has been launched by the government, which is more targeted in nature to grow this manufacturing segment. Um, and and on top of that, during the pandemic, what has happened that most of these companies have been able to delever their balance sheets. They are, from a fundamental point of view, at a better place, and a lot of capex, a lot of investments are expected to happen, starting from autos to auto ancillaries to defense manufacturers to heavy industrials, etc. And that is because of the strong demand which most of these manufacturing segments are seeing, and and obviously having a more robust balance sheet helps in allocating more towards the capital expenditure in order to cater to that demand. We expect the contribution to GDP of manufacturing segment to increase to almost 20% this decade. This is not only because of the fact that fundamentally the companies are better. We expect to see more demand for manufactured goods, especially as a substitute to China, especially due to import substitutions, but also because of the policy push from the government, including the PLI, which we believe can be a very strong growth lever for this entire space. Now, I mean, talking about the government push, I've already mentioned that apart from Make in India, Atmanirbhar Bharat, PLI is one thing which is very interesting, right? And what government is trying to do in PLI is government has decided to focus on 13 sectors, and unlike earlier, where the subsidies and incentives were given to several companies belonging to the sector, and which is why the incentives were very thinly spread out, they are focusing on 5 to 10 champions within each sector. The idea is that let's focus on 5-10 companies. If we are able to incentivize through taxes, subsidies, etc., on provide a subsidy of almost in the range of 5 to 10% of incremental revenues, then the incentive of producing more is there. And when these companies are able to meet the output target based on which the incentives are given, there will be an entire supply chain associated with these set of companies, which will also grow along with it. And that is a very different approach which government has taken. It also wants to increase the value addition in a lot of industries. Just don't be a simply assembly units, improve the value addition which is happening in India. And that is why we believe that this production link incentive, which incentivize companies to produce more, to reduce the imports, to produce more within India, to come out with more, create more manufacturing units, is something which will push manufacturing segment as a whole in India. And government has spread out this incentives, and still it is a lot of it is still in the process, and more clarity will come later. But from an Indian point of view, almost the entire scheme size is 2 trillion rupees. around, and out of which mobile electronics will alone have around 52,000 crores. Then comes automobile around 25 point 9 thousand crores, pharmaceutical around 18,000 crores, then comes white goods, especially ACs around 6,000 crores, then comes advanced chemical cells, which is batteries for EVs, which has a significant outlay of around 18,000 crores, specialty steel around 6,000 crores. So government is focusing on key manufacturing segment. So the first fact is that these segments are fundamentally better placed from a balance sheet point of view, from a leverage point of view. They are looking at good demand in coming years and are have planned for capital expenditure. And this entire thing is given more push due to the production linked incentives and other schemes by the government. And this is complete. The government has also completely changed the approach. The earlier scheme, which was MEIS, Merchandise Export India scheme, if you see a split there of 477 billion rupees, it was more so towards jewelry, chemical, agriculture, textile, etc. Whereas government right now has shifted the approach to focus on electronic goods, on automobiles, on pharma, on batteries, etc. So government is focusing on the sectors where India already has some amount of not leadership exactly, but presence, like auto and auto ancillaries are a significant portion of our global trades. Then pharma also, where we have significant presence in the generic market. But government is also trying two things. One, reduce the imports. There are imports which can simply be produced in India. Let's do that. And in spaces where it can offer an alternate to economies like China, because of the trade war, because of the other issues, companies want to move away from China. Let's say in chemical space, in electronic goods, be the China plus one, be the a country where these manufacturing companies can come up and set up spaces like Foxconn has done. And obviously, we'll talk about the tax incentive which government is now giving, which any new manufactured units in India, manufacturing units in India till 2023 is going to be taxed at 15%. If you add the cess, it will be around 17%, which is lower than the competing countries in Asia, and almost on a similar scale to China, which is around 16%. Now we expect the PLI to incentivize company to have capital expenditure of almost 21 to 22 billion dollars, right? Because if you have to produce more, you have to invest more, have more capital expenditures, and the PLI is expected to add around 75 basis point to 100 basis point, which is 0.75% to 1% in the GDP of India. And this is going to uh, probably propel the share of manufacturing from 17% to almost 20% in the overall GDP of India. So that is why manufacturing as a whole is very interesting space right now. What I'll do is I'll talk about few of the sectors on what the outlook looks like, and these sectors are key component of manufacturing space. But if you want to understand in more detail, the presentation is available on Mirae Asset website. You can go and read this presentation, which will probably provide a more in detail context about each of these segments. So first, let's start with auto. As I mentioned, that auto is something which is one of the most important manufacturing output contributor in India, and this segment has seen underperformance recently, right, and significant volatility recently, especially due to the lockdown, due to the pandemic, and the fact that there is a supply chain issue, especially on these semiconductor sides, which is affecting the entire supply chain. But having said that, we are seeing recovery, and we have seen recovery in last 12 months, and which is especially driven by the first-time buyers, even though the replacement demand has remained subdued. But we see that industry is in an upcycle, early stage of upcycle, uh, given that there's a large suppressed replacement demand, which we hope will come out. There's a continued buoyancy in the rural economy, and there's an improvement in financing, right? So increasing per capita income is also one factor which will drive the penetration of auto in India. Auto in India, from penetration point of view, is pretty low compared to even developing countries, right? Recovery in economic activity will result in higher freight demand also, and we believe that in 2022 there will be a better supply chain improvement in supply chain, which will drive higher production volumes in PVs and commercial vehicles. Apart from that, one very interesting thing is also happening is on the EV side. We all know about it. Incremental sales, while right now it is pretty low, around 1%, we believe that it will be double digit within next 5 years. So EVs will start having significant share of double digit in the overall sales within next 4 to 5 years, both in the two-wheeler space as well as the four-wheeler space. And this thing is also pushed by the government, which is trying to grow this entire EV ecosystem, especially as I mentioned that there is an outlay on developing the battery technology in India. Apart from it, good things are also happening on the white goods side and electronic industry side. As I mentioned, that there's a PLI push in white goods, which is expected to be around 6,000 crores of incentives focused on ACs and LEDs, which is going to drive this market, right, from a manufacturing point of view. And also on the electronics, we know that Foxconn is setting up has set up industry in India. The maximum amount of outlay in PLI is on mobile phones and its related component. And the idea is not only to produce more, but increase the value addition, which is right now around 15%, and increase it to almost 30%. So idea is not only to to produce, but to export and to increase the value addition which the companies are bringing in. Don't be a simply assembly assembly ecosystem. In the pharma sectors, we all know how well India is doing in terms of volumes in generic market. Under PLI, industry is getting almost $220 billion in next 5 years, which is going to billion rupees in next 5 years, which is going to incrementally add a production of almost $40 billion. And obviously, India is also implementing product patent regime to ensure the protection on the intellectual property and to support innovation. So we believe that until 2020, we will see almost a growth of 12% in this particular segment, which will be driven by not only generics but also novel products, by also things like universal health coverage, etc. Chemical is again a very interesting space, perhaps because now globally MNCs are trying to look beyond China. This is one place where India can be a China plus one player, and India, with its low labor cost, R&D focus, and more stringent IP protection law, is expected to be a key beneficiary here in chemical space. As I mentioned, that import substitution opportunities are also there. Government is trying to incentivize, push companies to import less, be a supplier in this, reduce dependency on the imports. And as I mentioned, that there are segments where companies have announced capex plan in next couple of years. We believe that a lot of domestic companies will invest more in this space. Just highlighting the underlying robust demands, right? Same story goes for petrochemical and the metals, where we believe that ultimately a lot of these companies have delivered their balance sheet to a more sustainable levels. We feel that government has imposed and come out with very good policies, especially when we talk about trade barriers, on import duty on steel, etc., which will revive this entire sector, and which has in fact revived this entire sector. So again, we believe that here also there will be a significant capital expenditure over next 4 or 5 years, just highlighting the fact that these companies are basically looking at robust demands going forward, including the steel sector. In finally in the capital goods and the defense, right? We are seeing government push on local manufacturing. That is something which will push this sector, right? And assuming that India achieves a 9.5% nominal GDP growth in FY 2022 and similar thereafter, we are looking at good capex spend here, and almost a healthy growth of 10% on infra related stuff. And here also, when we are looking at defense and heavy industrial manufacturing, we are looking at good push in this segment because of the Atmanirbhar Bharat, right? We are, especially on the defense side, things look pretty interesting if you are looking at the order book, etc. So just to summarize, right, we are looking at a segment which, first, from a fundamental point of view, is if we remove if we talk about capital goods, metals, chemicals, etc., the segment is looking more robust from a balance sheet point of view, is delevered. We are looking at more capital expenditure due to the underlying robust demand. These segments are trying to be China plus one and catering to the international markets, right? When you're looking at auto, we are looking at opportunity set due to revival of this particular sector, demand coming back, and also increasing demand and potential of EV technology. On the pharma, we expect India to continue dominate, and we look at almost around 12% growth from a CAGR basis in the industry for till 2030. So things are looking robust from a next 5 to 7 year point of view, and all this is being encouraged by the government policy initiatives like PLI, which I mentioned, that just a $2 trillion of incentives from the government in the range of 5 to 10% will in fact result in around 3 trillion rupees of investment from these companies, right? The pushes, the incentives is 2 trillion rupees around, which, if the incentives in 5 to 10% range, will propel around 30 trillion rupee of investment, right? And we believe that all these factors will push manufacturing to be a growth driver, increase contribution in GDP, make India grow incrementally more in coming years. Now, this is why this very new index. Let's talk about the index now, and this is why this very new index is developed by National Stock Exchange. The idea is not only to capture sectors which belong to the manufacturing segment, but cover it in a manner that each manufacturing space gets represented. The idea is that obviously, as manufacturing companies does well, portfolio does well, the investor is able to get the benefit of the performance of the manufacturing segment as a whole. And now that we have talked about PLI, I'll show you the portfolio and the sector breakup, you'll also realize that almost all of the segments which are the focus area of the government through PLI and Atmanirbhar Bharat or Make in India are getting captured in this particular portfolio. So let's talk about the index first on how Nsc has created this index. So the initial universe is Nifty 100, mid cap 50, and small cap 50. So all large cap stocks are considered, all mid cap stocks are considered, and then 50 small cap stocks are considered. So the initial universe is top 300 stocks. Then Nsc has defined basic industries which can be categorized as manufacturing segments. So rather than defining at a very broad level, they have defined it at a very granular level. So for example, within auto, they have defined basic industries as two-wheelers, four-wheelers, commercial vehicles, tires, batteries, etc. So they have gone in more granularity to identify the right segments which belongs to this manufacturing space. So in a nutshell, what doesn't belong? Nothing from banking and financial services belong here. Nothing from IT belong here. Nothing from infra segment belong here. So all those real estate companies, cement companies, logistics, etc., does not belong here because they are more part of infra theme. And also your FMCG does not form part of this portfolio. So this portfolio is manufacturing, which exclude BFSI, IT, FMCG, and your real estate, logistics, cement companies, right? So the focus is purely on manufacturing segment. Now, after each of these basic industries have defined, and basic industry, as I mentioned, are the most granular classification, top 75% of companies from each of these industries are selected to form part of the portfolio. So from two-wheelers, top 75% of companies will be chosen. From four-wheelers, top 75% of companies will be chosen. From tires, top 75% of companies will be chosen, and so on and so forth. Now, with one condition, that all large cap companies which are within the eligible industries should form part of this particular portfolio. And hence your portfolio is constructed. Right now, the portfolio consists of 79 companies from within the top 300 space, which form part of the eligible basic industry. Now, to make it more relevant to how the manufacturing space looks like, two things have been additionally done by NSC. One, that automobile and industrial manufacturing, which are the two most important, or rather the two core segments of manufacturing, will have at least 20% weight in the portfolio. So if they don't have a 20% weight, the weight will be increased to at least 20%. If it is more than 20%, then it will be more than 20%. So these are the two main components, and that is why they will have at least 20% of the portfolio. And just to reduce the concentration risk of the portfolio, the weight of each stock is capped at 5% each. So no stock at the time of rebalancing will be allocated more than 5% weight. This is how the breakup of sectoral breakup of manufacturing index look like, and just look how different it is from Nifty 500 and Nifty 50. Automobile is around 20% plus, industrial manufacturing around 20% plus, pharma at 17%, metals around 14%, petrochemicals around 9%. So you don't have extraction companies like ONGC, but you have petrochemical companies which are around 9.3%. Then you have consumer goods, which are the durable goods at around 7%. Chemicals around 6.4%. Then comes the fertilizers and pesticides and textile. Just contrast it what the exposure at Nifty 50 is. So just open the Nifty 50 index or any large cap or any flexi cap fund, you will find higher allocations towards banking and financial services. You'll find higher allocation towards IT. You will find allocations towards consumption, etc. So if you so typically what I'm trying to say here is that if you move from a Nifty 50 ETF to something on the large cap side or something on the flexi cap side, the chances are your sectoral allocation will not change much, which is one additional benefit which India Manufacturing Index provide. That from a sectoral exposure point of view, this is providing you exposure typically which no other large cap or flexi cap or index funds which are based on Nifty 50, Nifty 100 will provide. So it will add to the portfolio diversification. It will typically help reduce the overall risk of your portfolio because of this diversification. And if you are obviously keen on the manufacturing segment opportunity, then this is the space to be present in, apart from the fact that it also helps in diversification. Now, in terms of distribution, almost 63% of the portfolio is from large cap segment, 43% of portfolio is from mid cap segment. Sorry, 35% of portfolio is from the mid cap segment. So you have a decent representation of mid cap in the portfolio at around 36%. So it gives you a view of both large cap and as well as the mid cap segment. Now, one very interesting point, let's just talk about performance, right? We are talking about a theme from next 5 to 7 year point of view. And whenever we are talking about thematic investment, the idea is to board the bus before it is too late, right? So if you believe that in the next 5 to 7 year point of view, because of the PLI push, because of the way companies are probably investing or plan to invest more on setting up units, on increasing their production capacity, etc. Because of the underlying demand, then probably this is the time to board the bus to get that returns from next 5 to 7 year point of view. But one thing which we typically associate with manufacturing is that it hasn't done well, right? In last 10-15 years, but that isn't the case actually. So if you look at India manufacturing, it has given 14.5% return versus 14.9 since inception. Inception was 2005. But if you look at last 10 years, it has given 14.2% return versus 14.8 with Nifty 50. If you look at last 3 years, around 16.4 versus 17.4 versus Nifty 50. So it hasn't done poorly historically. It is round about what Nifty 50 has given, right? Future prospects aside, even if we look at calendar year point of view, which will give you a better return, because when we talk about manufacturing as a segment, it will be more cyclical in nature. Manufacturing will tend to do well when the country is growing. There is a better GDP growth, better economic growth. There's more optimism in the economy, and which is what you will see, right? And one very interesting point also is I'd like to point out that if you look at last 8 years, you'll be surprised to know that manufacturing has given better performance in 6 out of 8 years. So in 2021, 31.5% return versus 22.9. In 2020, 24.7 versus 16.1. If we look at 2017, 32.7 versus 30%. If you look at 16, 7.6 versus 4.4. 15, 3.1 versus minus 3% of Nifty 50, and 2014, 47% versus 32.9%. So the segment has done really well in 6 out of 8 calendar years. I think the 2 years where it hasn't done well are 2018 and 19, when the markets, as we all remember, were very polarized, right? There were only 10-15 stocks which were doing well, and a lot of these segments of market weren't doing well. And as as I was talking about cyclicality also, you see that in 2009, 158% versus 77% of Nifty 50, in 14, 47% versus 32%. So when there's a positive uh, outlook on the economy, on the growth of India, which we have obviously from next 5-10 year point of view, the manufacturing has to do well for India to also grow at the pace at which it desires. And in any case, we know, like we have talked about it multiple times, what the underlying fundamentals of the segment is, and how the government is pushing the entire segment to grow and do well. Now, if you look at the portfolio, like I mentioned, that you'll find representation from the basic industries which are in top 300 space, and that's visible. If you look at the portfolio, you have Reliance Industries at just below 5%. As I mentioned, that 5% is the cap which is done on the rebalancing days. Then come Tata Steel, Maruti Suzuki, Sun Pharma, Tata Motors, Mahindra and Mahindra. As you go down the portfolio, you'll find representation from Cipla, from Bharat Forge, from UPL. On the fertilizer side, you'll find Havells India, Pidilite, Voltas, Human India. On the durable side, you have Page Industries. If we go down, you have Dixon Technologies, etc. So you have companies from various facets of the manufacturing segment. Idea is that the government push is around on the 13 segments. The portfolio not only focuses on just one sector, it focuses on the entire manufacturing segment. So it also diversify your risk over the cyclicality of just one segment, right? If auto hasn't done well, your metals, etc., has done well, and your portfolio will obviously be more distributed, and performance will be, let's say, less uh, uh, impacted by, let's say, a downturn of any particular manufacturing segment. Now, in terms of valuation, also, if you look at the trailing 12-month PE, we are looking at current trailing 12-month PE at 21.6, which is just over the historical average of 21.4, 15-year historical average of 21.4. So valuation wise, on a trailing PE wise, it doesn't look expensive. It's round about the average. Though on the PB side, it's around 3.74 versus the historical average of around 3.18. Now, just to quickly conclude, why you should look to invest in this fund. There are reasons are multiple. I think I'll probably take two. One is obviously from a fundamental point of view, there are segments within manufacturing segment, like we talk about chemical, metals, capital goods, etc., where we see that there is a strong underlying demand. There will be capital expenditure to increase the production capacity, which will the companies are sitting at a better balance sheet, and we see those segments doing well. On the other side, auto, while it has seen headwinds recently, we see that demand will come back, especially on the substitution side. But also we believe that the potential is there for, due to the focus on electric vehicles, also not only from the manufacturers but from the government as well. This entire outlook of the manufacturing segment is also being very ably supported by various government initiatives like production linked incentive scheme, which we have talked about earlier. That is the one portion. Second is that there is a low overlap on Nifty 50 with Nifty 50 and other active funds, right, which are more focused, let's say, on BFSI, consumption, IT, etc. And here we are talking about a completely different set of segments and companies being covered. So investment in this portfolio will help investors diversify their portfolio. So if you are bullish about the manufacturing segment of India from next 5 to 7 year point of view, you believe that fundamentally companies are at a good place. Demand is there, and also if you believe that initiatives like production-linked incentives will give more fruitful results, then this is probably the time to invest in this portfolio, and not only potentially gain the benefit of the performance of the manufacturing segment, but also reduce the risk of your overall portfolio, because ultimately you are diversifying your holdings to different sectors also. As I mentioned earlier, there are two ways to invest in this particular scheme. One is through ETF, and the second was through fund of fund. ETF will invest in the stocks directly. The NFO has opened on 10th of Jan. It closes on 20th of Jan. The allotment will happen on 27th of January, right? And the listing will be within 5 working days from the date of the allotment. And the fund of fund has already opened on 20th of Jan. It closes on 24th of Jan, and the allotment date will be on 31st of Jan 2022. Here you can do opt for facilities like SIPs, STPs, etc. So that's it from me. I'll be taking questions if there are from the audience. So if you have any questions, just mention your questions in the question box, and I'll be taking a few of them. So I think first question is from Gautam. What is the difference between two fund and what are the benefits? I've already mentioned that it's up to the investors, right? One is ETF and the second one is the fund of fund. ETFs gives you the option to buy and sell even a single unit on the exchange at intraday net asset value. You need to have a demat account for that. ETF typically comes at a lower expense ratio. For us, it will be around 40 basis point pre GST. The fund of fund, if you want to buy and sell based on the day close NAV, you want to do facilities like SIPs, STPs, etc. directly with the AMC, then you can opt for the fund of fund. Fund of fund obviously come at a bit of a higher cost. So incrementally, if I talk about from a direct fund of fund plan to the ETF, typically the TR difference will be around 20 basis point, which is just 0.2%. So it's up to the investor to choose the right investment vehicle. So I think there are a couple of questions on the method of selecting companies. So I've already covered that, so I'll skip that. Yeah, so there's one question. While I'll not take the name of the fund, the question is from Vishal, how it is different from an XYZ manufacturing fund. So basically, this is a more rule-based approach. The method is out on which segment the portfolio won't have exposure in, right? And then if you look at the concerned scheme, it may have exposure probably in the FMCGs and probably in the infra segment also. But here it's more crystal clear on where the investments will be. And also on the TER point of view, this is a scheme which is on the ETF side will run at around 40 basis point. Whereas if you look at the direct plan of the concerned scheme which you're talking about, it's on the higher side. So then you can accordingly make the decision whether you want to stay invested in that concerned fund or whether the portfolio of India Manufacturing Index appeals to you more. One question from Vikram is whether the ETF will have enough liquidity. So in all our schemes, the market maker, the liquidity provider, is our sister concern, which is Mirae Asset Capital Market, and which provides liquidity at all points in all our ETF around the net asset value. So just go and have a look at any of our ETFs, be it Nifty 50, Nifty Next 50, etc. Even if the demand from investor is there or not, there is the bid and ask code always mentioned by our market maker, and will always be there. So, for example, even if the demand is for 1 crore or 5 crore or 10 crores, the same is managed by our authorized participant, which is a concern. So, in case of Mirae Asset ETFs, we have managed liquidity in the best possible manner, and then typically you won't find any challenge in buying or selling ETF units of Mirae Asset on the exchange. One very important point which I'll also like to highlight is that our domestic ETFs typically trade around cost to cost price. Our sister concern does not add any additional spread on the ETF unit. So if you're right now, if your net asset value, real time net asset value is rupees 100, and the cost of creating the ETF unit is around 15-16 basis point because of STT, stamp duty, etc., the quotation will be 100 rupees 16 paisa on the sell side and 99 rupees 84 paisa on the buy side. So that is how there's no additional cost or spread which is levied. It is on the cost to cost basis typically. So that is one additional advantage you have when you buy and sell Mirae Asset ETFs. Yeah, so there's one question on the taxation also. So from a tax point of view, both FOF and ETF will have same equity taxation from both long-term capital gain and the short-term capital gain, as accordingly will apply. And one question is on the risk aspect. So see, one thing is that instead of, so there are 2-3 things you should take note, that this segment is cyclical in nature, right? Like several others, right? Banking also is in terms of performance cyclical. So there will be times when this will do very well, and there will be times that it may not have us, it may underperform, right? Because that is how typically manufacturing segments are in phases of economic growth and in positive outlook, it tends to do really well. Now, one thing which the fund has already done, or rather the underlying index has already done, is that it is not focusing on, let's say, just auto or just metals. It has decent representation from auto, from pharma, from industrial manufacturing, 14-15% from metals, then comes petrochemical around 10, then comes consumer durables at 7, and chemicals around 7. So from an allocation point of view, since it is spread out in multiple manufacturing segments, the risk is automatically reduced versus investing in just one segment of the manufacturing sector. So that is how risk is mitigated if you look at an overall portfolio point of view, because you are diversifying from your holdings, which are typically there in BFSI, IT, consumption, etc., into a manufacturing centric portfolio. Because your allocation is changing from a sectoral allocation point of view, your overall portfolio risk will also reduce. Having said that, typically, as I mentioned earlier, if you just look at the product alone, it may have a higher volatility than, let's say, a Nifty 50 portfolio. So I think those were the questions from the audience. So I think it's 2 o'clock, so the time is also up. So thank you so much, everyone, for listening to this webinar. We hope for your participation in this very interesting NFO which we have come out with, which will provide investors the exposure to the manufacturing segment of India. So take care. Uh, Take care of your family also, and mask up.